The only big takeaway is the Bank of Canada sees the current rate at neutral, and we know that that's a range, and they're right in the middle of that range right now, and so we acknowledge that they've kind of reached their neutral rate. So any additional movement in the rate would really depend on their outlook going forward on the economy. But I do think the concern going forward is potential deficit spending and increases in deficits, and you're starting to see that at the provincial level. You will likely see a federal response once we have a new government in place over the next few months, and all of those factors do come into play. That being said, Canada's in a position of strength. It has room, it has fiscal capacity, and we saw it, during the pandemic, for example. Everyone talked about how aggressive the spending was, and we've recovered fairly well from that, and it proved to support the economy. And I think in this instance, the Canadian positioning lends itself to availability of the government stepping in and helping the sectors that are hit hard. And I don't think anyone anticipates you need pandemic-type support in this case. And so we've shown that we do have the fiscal capacity, and that's going to be important as well. Where rates are and where yields are, fixed income is more attractive. You are earning income on the portfolio. Yes, it doesn't look as attractive as when 10-year yields were in Canada well north of 4% and 5% in the US. But at that point in time, you can see fixed income is doing what it's supposed to, right? We've seen negative correlations with equities come back. They're providing protection in a portfolio. You're earning anywhere from 3.5% to 4.5% on a bond fund, depending on the specific mandates. And so you can expect over time, you will roughly earn that yield and that return, especially when you have kind of a range-bound environment. And that yield gives you some cushion against the volatility again, because you're earning some income as things are moving around. And again, we pointed to all the risks currently that exist, and that would bias things to potentially needing to cut rates further if there is continued trade wars and it persists. And so you still have that protection and that upside should rates continue to come down.